Hi, everyone, and welcome to another episode of UBS Road to the Election and Election Watch series. I'm thrilled to welcome today's guest, Phil Orlando, Chief Equity Market Strategist and Head of the Client Portfolio Management Team at Federated Hermes. Phil, great to have you in the studio.
Thank you very much for having me. It's my pleasure.
Yeah, good to see you. And, you know, we were just talking a little bit beforehand. We've got this election coming up, obviously. That's sort of stating the obvious.
Is there an election coming up?
Maybe, perhaps you've heard. But it's the only thing we can all talk about, and hence the reason why we wanted to bring you in was to kind of get your deep institutional kind of knowledge on the markets here. And I think one of the big questions that we keep getting from our clients and our advisors alike is about the individual equity sectors. And particularly given the scenario that we're in, which is it's a pretty tight race, you know, it's really 50-50 if you look at the margins of error, even with the polling, whether it's Vice President Harris or former President Trump. If either one of them gets elected, what do you see as potentially affecting, or what could affect individual equity sectors, and which ones are you really keeping an eye on?
Well, one of the biggest mistakes that investors make is they sort of go into an election, particularly now with the sides so polarized, and that's been the case maybe over the last 15 or 20 years, thinking that there are going to be winners and losers depending upon who wins. That if you're the Democrat and the evil Republican gets in, then I'm going to cash out and just go to, you know, ammunition, corn, and gold. And vice versa. The reality is that you've got to be in it to win it. That the dynamism of the U.S. economy is such that the market up and to the right over time, over the decades. And whether you've got a Democrat or a Republican in the White House probably doesn't matter. So I would look at the question and say, be invested in the equity market if you've got a longer term time horizon, and based upon the dynamics of economic growth, earnings growth, inflation, interest rates, valuations, the areas of the market we think are going to do best here is sort of a fade from the dramatic outperformance of the Mag 7 names over the last couple of years. There's a catch-up trade that started to develop that we believe will benefit small cap names, domestic large cap value names, and international names. So I'd stay invested, but shift the portfolio from a sort of growth and technology focus to look at the other areas with high quality names, low PEs, low betas, high dividend yields, areas that really have been left for dead and have a lot of room to play catch up.
Right. And I mean, it's true. We've looked at the stats, and I know you've done the same thing. Essentially, the S&P 500 on average is, you know, 10% gains every single year since the 1950s, and that's regardless of who was running and who won, election year or not an election year. So the markets seem to be fairly nonpartisan, if as the case may be.
Well, an important element to that as well is, and we've done the work on this, that it's actually Congress that matters more than the presidency.
The down ballot elections,
well,
right?
Well, yeah, in this case, the Senate and the House of Representatives.
Sure.
It's the Congress that develops the legislation that the president will either approve or not approve, and it's that legislation that will determine the strength or weakness of the economy. So another way to ask the question might be, how do markets do? Do they do better or worse depending upon what the configuration is, the mix of, you know,
right.
You've got a president who could be a Republican or a Democrat. You've got a Senate, the same, House, the same. It turns out that historically, over the last 90 years or so, whenever the Senate and the House of Representatives were both controlled by Republicans, historically the market was up about 15% in those years. When the market, when the Congress had consolidated Democratic control, the market was still positive, but by a less amount. I think it was in the 5 to 7% neighborhood. The market is telling us that historically, they've liked the more market-friendly, economic-friendly, business-friendly
right.
legislations that Republican Congresses have tended to orchestrate. So, the president gets all the headlines, but it's the Congress that does most of the heavy lifting in terms of legislation.
What about the Fed, Phil? Because there's been a lot of, I don't know, talk on this campaign trail, and both candidates have come out and talked about their involvement or not wanting to be involved. Trump has said he wanted to be more involved if he became president again, and Harris has said, I would stay away from any monetary policy decisions. Historically, that is the case. The Fed operates on a nonpartisan basis. It's not a political part of the government, but also we know that the president can influence but can't make any decisions about policy. Do you foresee any reason why the Fed or even the direction of monetary policy could be affected by the president, not just the state of the economy?
So I like Vice President Harris's approach here better, having a very much a hands-off, standoff position from the Federal Reserve. Because if left to their own devices, any politician, president, senator, member of the House, they would want interest rates as low as possible to generate the strongest possible economic growth, strongest possible employment in order to enhance their own chances for election. I want monetary policy to be independently developed on the basis of what are the macroeconomic factors, both here and abroad. And so that suggests that independence is the thing that's most important. So you listen to some of the comments that President Trump has made in recent weeks about having him wanting to have some say in the establishment of monetary policy. I'm not a fan of that approach. I'm absolutely a fan of the independence of the Federal Reserve. Pick good governors. Let the regions pick good presidents and let those folks and their staff do their job.
Yeah, and since when the Fed was established, whether it was 1913 or 15, I can't remember the exact year, it has always been, it was designed to be standing outside of politics for that exact reason. And certainly that's an important point.
And that's the reason why I think that the chairman of the Federal Reserve's term is staggered with that of the president. So, for example, we're going to pick a new president in a couple of months. Chair Powell, who's the current chairman of the Federal Reserve, his term doesn't expire until January, February of 2026.
That's right.
So because you don't want to be, electing a new president, then have that new president come in, pick a new chairman, and then you've got a completely different direction on monetary policy. I also like the fact that over the course of history, you've had some presidents who have renominated members of the Federal Reserve that their predecessor, perhaps from another party, had put in place. They think they're doing a pretty good job. They think they can develop a good working relationship with that person, and so they, give them another 4 years to keep the flow going in the same direction.
Right, and that's a really good point. The president does have some influence because he or she is the person that nominates the potential Fed governors. Then it goes to Congress, and then decisions are made. So it's not like they're completely standing outside of the person or persons that they want there to represent the FOMC. But obviously, the decisions on monetary policy stand aside.
And we saw that with the Biden administration. They renominated Chair Powell, who was originally President Trump's nomination.
That's correct.
The vice chair of the Fed, Lael Brainard, actually came into the Biden administration. He nominated a new vice chair. There were 3 or 4 members of the Board of Governors that were open, nominated new people. So the Federal Reserve today, compared to 4 or 5 years ago, looks pretty different, in part based upon the ability of the president, as openings come up, to nominate their people, and there is a Senate confirmation, so there is a check and balance to the system as well.
Absolutely. Great. Thank you, Phil. I want to ask, because there is also, when we think about contested or elections that we haven't gotten a decision in a few days, I think we can go back to 2000 when George W. Bush was running against Al Gore, and it was a couple of weeks before we had all those hanging chads in Florida. They had to do the recount, but the S&P 500 between Election Day and the end of the year was down something like just under 8%. And so we can see the impact of contested elections that last a long time where there's not a decision. If we get another undecided election, which some people are calling for because it's so tight and it's going to come down to a few counties, as we know, in the electoral college votes, can you see an impact where the markets will react like they did in 2000 if we don't get a decision right away this time?
In a word, yes.
Yeah.
markets above all other things hate uncertainty.
Yeah.
And in that environment, the Gore-Bush election, which came down to a couple of hanging chads in Florida, we didn't know who the president was going to be and obviously what fiscal policy was going to look like. And the market was down about 7 or 8% over the space of a month or two until we got it figured out. So this election is looking like it's going to be very tight. If you have a contested election or if you get into a recount situation, that could happen again. So from an investment standpoint, you want to play a little bit of defense, which is kind of our theme here going into the election anyway. That would suggest a little bit of cash. Money markets are still yielding, 5.5%. That's not bad. Some bonds. Bond yields, we think could work lower over time, so there's a capital appreciation opportunity there. And then defensive equities that, again, high quality stocks with low betas, low PEs, high dividend yields, blue chip names. I'd love to have a portfolio yielding 4 or 5% while they figure the recount out and tell us who won the election.
That's right. Let's hope we don't have to worry about that, but it's a chance that it could happen. And everything you're talking about is very much aligned with our Chief Investment Office here, preparing for volatility with the U.S. election, and they do recommend a lot of the things that you just talked about here. Phil, let me just ask you really quickly, on the side of the U.S. dollar, is there any reason to believe that the election or whoever the president is could affect the dollar? I mean, let's be real. The dollar really is impacted by interest rates and capital flows and other factors. How much of it is weighed on who the president is? So
the key thing that I'd focus on is the fact that we are just in the very early stages of a Federal Reserve easing cycle.
Right.
We got that 50 basis point rate cut based upon the Fed's September SEP. It would appear as if they're going to continue to cut interest rates for another 2 years or so, taking the rate down, funds rate, 5.5% upper band down to a terminal rate of about 3%. In that environment, we would expect the dollar to weaken. Just look back to where dollar-euro was, for example, earlier this summer. We were at 1.05. Now we're probably around 1.11, 1.12. We would expect that it would continue to weaken if the Federal Reserve continues to cut interest rates because the U.S. economy is weakening and the labor market is weakening. So theoretically, a new president, new Congress could come in, put some fiscal policies together that would strengthen the economy, increase inflation. Maybe that would cause the Federal Reserve to alter its path, but in a status quo kind of an environment, you've got to take the Fed at its word that we're going to take rates down to 3% over the next 2 years or so, and that suggests that the dollar should stay weak and continue to weaken against the yen, the euro, and the pound.
Right. Yeah. Our base case here in CIO is that between the last week when we had the Fed cut rates by 50 basis points and next December of 2025. 200 basis points in total will be cut. And that's very much aligned with what the Statement of Economic Projections that the Fed released did say as well. So we have to, like you said, take them at their word.
Right.
And they will be data dependent, so things could change depending on what we see when it comes to the next couple months of data, especially jobs.
And that was what was interesting about the last Fed decision, that the change in the SEP from June to September was pretty stark.
Right.
The Fed was really happy with what was going on with inflation, really disappointed with the deterioration in the labor market, and that's, I think, ultimately what precipitated the 50 basis point rate cut as opposed to 25.
Excellent. Well, Phil, thank you. I wish we had more time. Really nice to sit with you. Thanks for all your insights. Really helpful stuff. Good to see you.
It was my pleasure. Thank you so much for having me.
Thank you so much. Phil Orlando, again, Chief Equity Market Strategist and Head of the Client Portfolio Management Team at our partners at Federated Hermes. And thank you all for joining us for this episode. For more, please visit our website at ubs.com/election watch. All the other episodes in the series are there for you to take a look at, plus lots of other election-related content coming out from our best partners and our own Chief Investment Office. And we do encourage you to continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone.